Hello and welcome to Livewire Markets The Pitch. I'm Ali Selby. Got a few quick stats for you. The S&P 500 has lifted 27% over the past 12 months. The NASDAQ has soared 39%. So is the US overvalued? To find out, we're joined by Wilson Advisory's Head of Investment Strategy, David Cassidy. Thank you so much for joining us, David.
Thanks for having me.
Let's get straight into it. The current S&P 500 10-year P/E ratio, or CAPE, is 33.7. That's 66.3% above the market average. In your view, is the US market overvalued?
Good question. The first thing I'd say, Ali, is I'm a little bit sceptical of the CAPE ratio. I think some people know that as the Shiller PE, which is a series that has a very long history. So I think it goes back to 1870. But I think sometimes you can have too much data. And I really think comparing the US PE at the moment to what it was in 1870 or even 1970 is a little bit dangerous. So while I think the US market is probably a little bit overvalued, I don't think it's as overvalued as perhaps the CAPE or Shiller PE is suggesting, because the US market is just so different to what it was back 50 or 100 years ago or even 20 years ago.
What measures indicate that it could be overvalued today?
Well, even on a more straightforward PE, either the last 12 months of earnings or the next 12 months, which is a little bit simpler than a CAPE ratio, which looks at the last 10 years, you still get the same message. There's some overvaluation there. So,
despite earnings growing over that period?
Well, that's the debate. I mean, you're looking at 21 times on a 1 year forward PE against, say, a short-term average of, say, 19 over the last 5 years. So that's giving the US market the benefit of the doubt in terms of it's really about tech now, and that's been the case for at least 5 years. So even on that basis, it looks maybe 10% overvalued. You could make an argument that there's so much growth coming, courtesy of the tech sector around AI, that you should pay that multiple 21 times. So it's not impossible the US market is not overvalued, but my inclination is to pay a little bit of attention to the long run averages. On that basis, I'd say the market's probably a little bit overcooked on the upside at the moment.
There are some experts who argue that there's some parallels between now and the 2000s tech boom and bust. Would you agree, or what's your thoughts on that?
Well, I think there's some similarities and there's some differences. It's clearly, tech has been leading the market. I think the market's not superficially as overvalued on a straight PE. The PE got to 25 in 2000 at the top, 21 now, so simplistically we're not quite there. The PEs of the tech sector itself are not as high. I think there was a lot of hope and expectation back in 2000. There wasn't a lot of earnings around at the time, so you had, in some cases, infinite PEs. This time around, there are a lot of earnings backing these stocks like Nvidia and Microsoft and the like. So yes, there's a fair bit of exuberance around tech. There's a lot of expectation, but I don't think there's as much froth and bubble now as there was back in 2000 from my perspective. So a little bit cautious, but nowhere near as cautious as I was back in 2000.
Do you feel like we could see a correction over the next few months, a little drawback, or could this be the start of a new bull market?
I think it's possible. It could be both. I think we're probably overdue for some sort of correction. I've thought that for a while. Possibly the bond market could be the catalyst for some sort of pullback. But I'm more in the camp that if we see a correction, it's more in the 5 to 10% area, not the 20 or indeed 50% we saw back in 2000, 2001. So more in the camp of correction within an uptrend rather than lapsing into a bear market.
Okay, David, last question for today. Investors are currently crowded into artificial intelligence beneficiaries like Nvidia, Microsoft and Google. If investors didn't have positions in these businesses today, would you recommend they buy them, or should they be searching for value elsewhere?
Well, I think a little bit of both, Ali. I think in the case of Nvidia, it's been very, very strong over the last 12 months with good reason in terms of the earnings delivery that it's achieved. But I think we'd put that in the hold category at the moment, not necessarily a sell. In the case of Microsoft and particularly Alphabet, Google, we still think there's an ability to accumulate or buy those stocks. Still think the valuations there are quite reasonable when you look at the long-term growth. So we're happily accumulating exposures in those. But I think investors should be looking beyond just the tech space in terms of their investment portfolio to other less strongly performed areas of the market. So we're doing a little bit of both at the moment.
Okay, well, thank you so much for your time today, David. It was a pleasure to have you on the pitch.
Thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.